Hello everyone and welcome to our second YouTube video where, as promised, I will be breaking down my largest portfolio holding, Alibaba. This has been a controversial investment, to put it lightly. I started a position in the company about a year and a half ago, and then it's continued to accumulate because I genuinely believe the fundamentals were so good. Why do I say it's a controversial play? A controversial play. If you probably, and especially if you are a market participant, you know that about 2 years ago, many people were calling China uninvestable. And what that because there was already a trade war going on between China and the United States, and to make it worse, there was a big real estate problem in China, which caused a lot of unemployment, especially among young people. And so, anyway, many investors across the world, but mainly foreigners, were calling the country uninvestable. And that led the big tech, in fact, companies across different industries, but especially big tech, to sell off substantially. And that came in combination with a series of government crackdowns on the tech companies, right? Because they really like to, in China, of course, they like to play a strong hand on the economy. And anyway, that led to a massive investor exodus from the country, and that does present opportunities for long-term investors like myself. And that was the case. So at the time, I was already aware of a company like Alibaba, because of many people call them the Amazon of China. It's a fantastic company, but is it a great investment? So throughout this video, I will delve deeper into some of the aspects that I'm looking for. You know that I like, and I continuously emphasize this. It's very important to do your own due diligence before committing any capital to a company. That said, full disclosure, this is my portfolio. You can see that I'm up in this position. So I want to show you here exactly where I started buying, and you can see if I just expand on this window. In fact, let me just close this. Yeah, all right. Let me just minimize this view. Yeah, okay, it looks better this way. You can see that $74.99 were my average price paid, right? So the stock is currently, it's practically a double. It was a double because not long ago it was at 148. Now the question is, will I sell my position or at least take some chips off the table, as it's commonly said in the space? And the answer is no, because I still believe there is a lot of upside potential. Per my calculations, the intrinsic value sits at about £200, and $200, and that can mean a triple, right? It was a large position for me at the time. So remember that a big chunk of this is not a fully invested portfolio. I want to hold a maximum of 6 to 7 companies. 7 companies, I'm happy, which means that I still have a big chunk of my network in cash, currently yielding 4.5%. And until I see meaningful opportunities in companies that I'm very interested in, I'm not deploying that capital, and I see no reason why I should do that. I'm a patient investor, and so I will definitely allocate when I see opportunities. And I have a series of companies on my watch list that I'm keeping a close eye on, and these are all great businesses from my personal understanding. And these are companies that I like to buy when the price is acceptable, when the price is attractive. Let's put it that way. So before I bought Alibaba, I did my own due diligence, as I mentioned, and that includes answering a series of questions. All right. This is our investment community on School, and you can see that about every 2 weeks we share a full investment deep dive deep dive on a specific company. The last one was on PayPal as well. Full disclosure, I bought a position in PayPal as well. But I always answer the same questions to all business. The questions are, as you can see here, you can see this as a 15 step process. Number one, do I understand the business model? That includes, I need to understand how Alibaba makes money, right? Its revenue streams, geographic splits. I need to understand these questions. Number two, is management capable? One of the things that happened with Alibaba was because the stock was plummeting and there was a lot of shareholder pressure. And the matter of fact is that the fundamentals did deteriorate over a short period of time, and that led to the CEO being fired at the time. So now there is another CEO who had been with the company forever. He has a lot of software development experience as well, and I think the company is on the right track. But so the question we need to ask is management capable? You need to look at the track record of the CEO. What have been his achievements in the past? And are you happy with those achievements? Do you think he can deliver on what he's promising? And then, does the company have a sustainable competitive advantage? And this is key, okay? Because I don't invest in companies that don't have some sort of moat that protects them from competition. This ties into Warren Buffett, Charlie Munger, and all these investing gurus' philosophies and principles. So you just think of it as a castle, right? There is a moat around it that protects them that stops competition. In fact, that stops enemies from invading, from trespassing. And that's exactly what I want in a business. And look, Alibaba had so many things going for them. They were the largest, at the time, they were the largest e-commerce player in China, and they still are the largest AI player in China. I noticed this straight away. Now everybody, once again, is talking about, oh my God, Alibaba is a phenomenal AI pay. Guys, they have been the number one cloud service provider and AI provider in China for a very long time. So anyway, again, so I do think, yes, they do have a competitive advantage on top of other things, right? So you have Alipay. Alibaba is a phenomenal ecosystem. They have they lock in their customers, right? And it makes it sticky. And so it's difficult for customers to choose other platforms or other service providers because they really have a very strong ecosystem, in my opinion. And now, is the company active in an attractive end market? This means I want to invest in companies that are active in a strong and consistent growing market. Think of companies in the healthcare space, in the AI space, in the clouding space. Alibaba is definitely one of those companies. And so, yes, they are active in this attractive end market. What about the risks for the company? This includes competition, this includes government interventions, which you have to be aware of. Anytime, especially with Chinese companies, and we saw that. And by the way, that was the main reason the stock plummeted. It's the fact that the government really intervened. They stepped in, and they don't have, how can I say, they have a very different culture in China compared to the Western world, right? And so they are not, the government can decide to step in whenever it wants. So it's a mix of communism and capitalism, and you have to be okay with that. But the trick here is, how much are you paying for that? That's the difference. The fundamentals are that, but then the price was so depressed that, in my opinion, all of those risks were already priced into the stock. And that gave me a tremendous margin of safety. Now, does the company have a healthy balance sheet? And this goes back I'm right now on a platform called Stock and Lock. I use Stock and Lock as a lot because I like to use it to analyze businesses. And when it comes to fundamentals, I think they are just fantastic. All right. So when it comes to fundamentals, these are the main aspects that I'm looking for: total revenue, return on invested capital, free cash flow per share, diluted earnings per share, and of course, book value per share. Typically, ideally, I would like to see all these numbers, all these metrics, compounding at 10% per year at a minimum for the last 10 years. Otherwise, well, I have to understand what's going on. Does this look like a dying business to you? So you can see that going back to 2015, Alibaba's revenue has compounded by 32% per year. The return on invested capital, the average for the last 10 years has been 12.4%. Return on invested capital is arguably the most important metric of all because it tells you how efficiently the management is deploying, is investing the capital, right? Which is why you want it to be higher because it means that they are putting your money to work effectively. That's what I want as a shareholder. Free cash flow per share. So it has been growing at 17.84. That it has grown at 70.4 compounded annually. This is phenomenal. Even considering all the investments that the company has been doing, we still managed to grow free cash flow per share very attractively. Then, of course, you have diluted earnings per share, also above 10%, and book value per share. Interestingly enough, when it comes to Baba, one of the main aspects of this company is their balance sheet. And here's another thing, another provider. Let me, no, what am I doing? Let me check. Here I use stock analysis as well. And if I go here to Alibaba, and if I go to the financials, to statistics, if you go to the balance sheet, just look at this. They have a net cash position, yeah, which means they have. How do you calculate net cash? You just do the total cash minus total debt. So they have a net cash position, and if you do the net cash per share, that's about £11. When I bought Alibaba, this was even higher because the company is now reinvesting a lot into growth, into AI and clouding infrastructure. So that has depleted the cash position a bit. And also they are doing a lot of buybacks because, in fact, they were doing a lot of buybacks because they knew how cheap the stock price was. And yeah, but look at this, book value per share. So this is the value of the company when you do total assets minus total liabilities, divided by the number of outstanding shares. The book value per share is 60. I mean, this is so if the company were to liquidate all of its assets, so this is the value of the company on the balance sheet without considering any future growth. All right. So if the company were to liquidate all of its assets today, then book value per share would probably be would be the. In other words, it means that if you buy $60 per share, you are investing with a big margin of safety, because if the company indeed were to liquidate its assets, this is how much you would get: $60 per share. We are not factoring in any earnings, any free cash flow growth potential, which is phenomenal because I bought the company at an average price of $74 per share. So you can see that I bought it with a big margin of safety already based on this metric alone. And sure enough, I mean, it was very cheap. So strong balance sheet. Why is this important? Because you don't want the company to face liquidity issues, right? And companies that do have a lot of debt on the balance sheet, they are highly leveraged. Then what happens is, if interest payments go up, they can struggle if they don't produce enough cash. They can struggle to pay off all that debt in a higher interest rate environment. and that can cause them to go bust. And that's why I like to invest in companies with pristine balance sheets. That was the case for Alibaba. Or the fundamentals, of course. I mean, this is a company. Look at this. I mean, if you look at the free cash flow, the how much cash the business produces. Let's go to the annual figure, and if you go to the free cash flow, you can see that right now it's declining because they are reinvesting a lot into growth. But if you go to the operating cash flow, which is the cash the business operations produce, you can see that, yeah. So, and if you go back, it's best if I just show you the long-term view. So let's go here to the free form of Alibaba. It's taking a bit. Let me see. So this is the margins. Okay. So okay. Before I talk about the operating cash flow, now that I have all the margins here, why are the margins important? Margins are a percentage of revenue, right? And so what you can see is that typically you want to see margins going up. But what happened since 2014 is that margins have come back down substantially, right? And that caused a lot of fear in the markets as well, which caused the stock to sell off. It was another important contributor. So look, the stock collapsed 75-80% from the highs, not just because investors were scared of the Chinese government. No, the company's fundamentals also deteriorated, especially because of competition. Competition was fierce in the e-commerce space, with the likes of with names like PDD, right? Selling, providing a service at a lower cost. Sorry, providing products at lower costs, which really caused some pain for Alibaba here. And so margins got squeezed until they bottomed out around in 2022. And now they seem to be slowly but surely going back up. Very good here, right? This is very good. And it means that the company is once again back on profitability, on a profitability, is back on the profitability stage, which is something that I like to see as a shareholder, and what makes me feel bullish about this company. But okay, so let's get rid of the margins, which we already detailed, and now let's look back. Let's look at the operating cash flow and operating cash flow. All right. And if we go back to 2015, this is the operating cash flow, the cash the operations generate. You can see that it was going up since 2016, and then around 2021 COVID time, in the crackdown on big tech in China and all of that, it just plummeted as well. But now it seems to have, here it collapsed, but it's once again on the way up. This is something that I like to see as well. So overall, if you just zoom out, and remember, we are long-term investors with a long-term view, you can see that cash from operations has definitely increased while price continued to come down, right? And this is what I'm looking for, everyone. I want that disconnect between value, between the price and the value of the company. And so exactly. Healthy balance sheet. Now, do they need a lot of capital to operate? I'm going to show you my my financial analysis sheet. As you can see, I've been jumping between different stock analysis platforms, which is quite annoying, and that's why I like to combine all the information together, and that's why I have a sheet that I like to track. So you can see here, this is Alibaba, current share price. This is all the relevant balance sheet items, income statement items, and cash flow statement items. And then that all leads me to some of the most important ratios and metrics that you can see on the right-hand side. For example, these are valuation ratios. This is the profitability. You can see the gross margins right here. So I like to put everything together, right? And then based on whether they are good or bad, I can see the green cell or a yellow cell if it's okay, or a red one if it's not okay. If it's quite expensive, for example, then you will see a big red cell right here in the valuation ratios. But look at the capex. So we were answering this question, right? Where is it? Does the company need a lot of capital to operate? And you can see that the capex divided by sales revenues is only 3.4%, 3.14%, which is quite good. Remember this, Alibaba is a company that reinvests a lot of money into growth. And so capex can be split into maintenance capex and growth capex. That growth capex is money that the company is using to build new things or to invest in AI, cloud service, cloud infrastructure, and those investments can deliver profits in the long term. So we exclude that. What we want to analyze is maintenance. How big is the maintenance capex relative to sales and relative to to operating cash flow? And you can see that it's 3.14 as related to sales. I'm okay with that. Ideally, I want to see this below 5%. And then capex divided by operation cash flow, that's 19. That's a bit high. But you can see, so ideally, I like this number to be around 15. But I mean, considering all the positive, all the other fundamentals, I'm okay with this. Okay, provided it doesn't continue to grow much, it won't continue to grow beyond this. Otherwise, that would be a red flag, and I would have to analyze what exactly is going on here. Right? So that's another question. And that aside, is the company a great capital allocator? And here is where Royce comes into play. Royce is you want to see that the management team is allocating capital efficiently. In other words, you want to see that the way they are allocating capital, that's going to translate into profits, right? And you can see that as I showed you before, if I go here to Alibaba, I can show you right here. Look at this. That's Royce. I have it here. These are my big 5 numbers. Remember, Royce, book value, earnings, sales, earnings, free cash flow. Look at Royce. Current Royce sits at 11. You can see the 3-year average is 8. The 5-year average is 10. So right now we are at 11. There is a consistent improvement, which is something that I like to see. And the 10-year average is 13%. Overall, we can say these numbers are at 10 or above 10%, which is very, very good. Okay, this is very good. And yeah, so here's you go. That's your answer. How profitable is the company? We've already discussed that. Do they use a lot of stock-based compensation? This is something that I like to track. Management will use, so a company will use stock-based compensation to attract great workers. In other words, if you want to work at my company, I can give you a bit of stock, right, to make sure that you stay with us for a long time, right? Because what some companies do, for example, Amazon, is you have to stay with the company, for example, 5 years before you can, or 3 years, something like that, before you can sell your shares. So look, it's a way to attract and retain talent, which is something that is common across the tech space. All right. Now, there is a limit to how much stock-based compensation a company can do, in my view, because stock-based compensation dilutes existing shareholders, and it's an important expense And I don't like that if it's too much. All right. But that's not the case with Alibaba. So what they do is acceptable, and I'm okay with that. Now, did the company grow at attractive rates in the past? There was, of course, this speed here. Did they grow at attractive rates in the past? Let's see. For example, these are all our numbers, and you can see that. Look at these metrics. Of course, diluted, in fact, earnings per share plummeted substantially. The company was struggling profitability wise, and this is definitely a red flag. It was one of the main things that caused the stock to plummet and investors to become so bearish on the company. But the other metrics you can see have all grown at well above 10%. And then this is a question of why was profitability being hit? There was competition in the market. The company was doing a lot of investment that were not delivering the necessary profits at the time. So it was a big red flag. But now, as we saw, based on the company's margins as well, this has been improving, which is something that I like a lot. Okay, and now we are starting to come into the all important aspects. Does the future look bright? So, what are analysts projecting for this company? And you can see if I go here, for example, if I go to statistics, you can see these ones don't share here, but if I look at other providers, in fact, some of them are telling me analysts are projecting 5-year EPS growth, so earnings per share to grow at 15% per year. And that's the number that I will be using for my valuations. Now we are coming into the valuation side. And when it comes to valuation, I like to use what rule number one investors do. Disclaimer here, I attended in it's best if I show you here. So rule one investing. Rule one investing. So rule one investing is the company, and they do a 3-day virtual workshop every now and then. I attended the workshop because I invested in my education. I learned quite a bit, and the framework that they use to value a company, I think, is very helpful, very conservative, and that's the framework that I have laid out right here. So there are 3 processes: margin of safety, payback time, and 10 cap rate. And let me know in the comments if you want me to break them down later on. But long story short, you can see that once the calculations have been done, the margin of safety price for Alibaba was around $100 per share. And the stock is currently and I started buying the company at $74 per share. That gave me a tremendous margin of safety because per my calculations, the intrinsic value, the real value of the company was around $204 per share, $200 per share. So I want to buy the company at 50% off. That was 100, and if in fact I could buy it even below that, that's how depressed the price was. And based on payback time in 10 cap rate, you can see the valuation was pretty much similar. So it was around $100 per share. That was the margin of safety price. So a big discount to its intrinsic value, right? And payback time is one of my favorites. This is based on how much cash the company produces. The question that you are making is, you want to buy the company at a private you want to buy the company at a private price. In other words, private companies typically sell for 8 times earnings, right? Where the average for the S&P for a publicly traded company is 16 times, 15 times earnings. And so if you can buy a publicly traded company for a private at a private company price, that's a tremendous bargain. And the question, and in my case, is 8 years. You want to be able to get your money out, your investment out of the company within 8 years, right? And so if the answer is yes, let's say based on how much cash the company produces, how long will it take you to get your money back? And if you do 8 years, yeah, if we consider 8 years, I would have to pay an average price of about $113 per share. That's a big margin of safety. If the company is able to grow its cash flows at the projected 15% per year. Okay? So if we grow free cash flows at 15% per year, in year 8 we get this cumulative, and if you divide to 762 by the number of outstanding shares the company has, then we get this free cash flow per share price. Yeah, very good. And so it reinforced my belief that the stock was definitely cheap and that I was buying with a big margin of safety. And so I did all this analysis, I did my due diligence, I answered all the questions that you can see here. And of course, I answered the questions, does the company trade at a fair valuation? And should I invest in the company? And my answer was yes, that I'm comfortable investing in the company because the probabilities are in my favor. And there is no such thing as a certain investment. You always have to play with the probabilities. That said, I strongly believe that the probabilities were in my favor because at $74 per share, the stock was ridiculously cheap. And if you did a discounted free cash flow analysis, for those of you who are new to this, I do a discounted cash flow to put an intrinsic value on the company as well. It's another way to value a company. So based on the company's future cash flows, how much should you pay? You can put a value on the company, right? So if the company, you determine you determine the growth rate for those future cash flows, and then you discount those future cash flows back to the present at the proper discount rate. I know it sounds tricky, but let me show you what I mean. And so I do this is the discounted cash flow, and it comes with the metrics. It's not difficult, but you will find it a bit complex if you are just getting started. But once you get the hang of it, it's quite straightforward. And for 2025, we have these cash flows, and then once the math is done, that gave me a discounted free cash flow price per share of 126, which coincides with my other valuation metrics values, right? So very good. And then of course I like to use the reverse discounted cash flow, where you just as Charlie Munger said, if you want to find a solution to a complex problem, just turn it upside down. In other words, with the reverse discounted cash flow, we want to know what growth is currently implied in the current stock price. And a good way to do that is that the stock price is currently at $132 per share. I always want a 15% minimum return on my investments. And if you assume the stock can grow at say at 15%, which is which is what I think the company is going to be able to deliver, right? It's what analysts are estimating as well. Then the intrinsic value per share will be around $118 per share. Okay, and this is provided the stock is currently trading at 135, as I mentioned, so it's already a bit overvalued based on this. Unless the company can grow at greater than 15% per year, which I think it won't happen. But the point here is, everyone, I paid $74 per share. So this stock, let me go back here, at $74 per share, you can see that the stock, the intrinsic value was $75 per share. That was the price. The market was that was the growth. That was implied in the stock price when it was trading at $75 per share, which in my case, in my opinion, is ridiculous. So the question you are asking is, do I think Alibaba can grow at 7% per year over the next 10 years? And if the answer is yes, then of course you should be comfortable paying a $75 per share price. I hope it's been clear. So look, I just broke down my investments in Alibaba, why I decided to make it my largest portfolio position, because I just saw so much upside potential for the company. And I thought it was a bargain based on what the company could offer me, and that I really had a big margin of safety. And last but not least, it's important to understand that the future of Alibaba is closely tied to the Chinese consumer and the future of China. Because of the real estate crisis, the Chinese consumer pulled back on spending substantially, and of course that affected Baba because a big chunk of their revenues comes from Taobao and Tmall. That's their Chinese commerce. I think 60% of their revenues are coming from Taobao and Tmall. So if the Chinese consumer is not buying their products, of course the profitability is going to plummet, right? It makes a lot of sense. But so the question you have to ask is that going to go on forever? Or is there going to be a time where the Chinese consumer will once again start spending money because the economy is improving? And my belief was yes, of course. The business cycle goes through these periods of expansion and contraction, and the same happens with the economy, and I do believe we are currently on the recovery side, and that this should bode well for a company like Alibaba, because it will mean higher profitability as the consumer begins to start spending more money on their products. Okay, so that's it. So I hope you guys liked it. It was a full, a jam-packed session here, but as I mentioned in my my first in our first YouTube video, this is something that I want to do. In the next one will be about my second largest position, which is Evolution AB, another controversial play in the online casino industry. And I decided to make it my second largest position, and I am still pondering to add. Well, I'm still pondering to add more to it, but I'm gonna have to do some more due diligence on the company. But I think this is going to be another company that once the market realizes its real potential, they're going to have to reprice the stock, and that's going to mean a triple, or a triple at least. Well, a double for sure. And then I want to. This is one of those companies that I would like to run I would like to stick with it for the very long term. I don't think I will be able to do that with Alibaba, because if you look at a chart of Alibaba, the company goes through these periods that they crashed many times. Look, it's different in China, all right, but in a more capitalist country like the Western, more capitalist countries like the Western world, then if the company is amazing, you want to make sure that you stick with it for as long as its fundamentals continue to improve. Okay. So let me know in the comments if you like the video, or if you like me to discuss anything else in future videos. And that's it. Let's build wealth together. That's the goal of this community.